All right, what's going on, everybody? Give me just a couple minutes. I popped on early so that I can test out my X Live feature. We have X Live now, and I just need to go and multiple output, X stream for FXE start. And if we did this right, ladies and gentlemen, I should be live on X as well. So let me just go and play with this. That's why I popped on a minute early. The scheduled timing is 0 minutes to go live. What we got here? Maybe I gotta wait a minute. Oh, here we go. This plugin is provided for free. All right, I got the plug in, so give me 1 second. Now let me just go over to X and see if it's working. And then I'll be 100% ready to roll. FXEmpire. There it is. Hey, it says live. Live. Hey, we're live on X. Perfect. Perfect, perfect, perfect. All right. Well, ladies and gentlemen, welcome back. We got quite a few things to talk about today. So, again, for anybody that's just popping on, YouTube is the way we went for all this time, and we were doing something a little different, playing around with the X Live. So I think everything's good. I see it live on my computer, so I think we're good. So anyway, guys, chime in, say hello, let me know how you're doing out there. And as always, if you have any tickers you're keeping your eyes on, we had a lot of moves today because of a couple different events. Well, one main event. Yeah, we'll definitely talk about that. We'll look at the economic calendar as well. And might as well just lead off with the elephant in the room, guys. As you, hello, NBVN. What's the Fed's comments? Yeah, I'll get to that in just a second. So the elephant in the room. Well, the Kevin Warsh, they jokingly called him the hedge fund of the Federal Reserve, the hedge fund of Kevin Warsh. I'm sorry, guys. Scott Bessent, the Treasury, the hedge fund of the Treasury, as a joke. Anyway, they decided to release today that they're doubling up on their buybacks, their bond buybacks, what's called bond buybacks. So doubling the size of that to at least 4 billion. That's a hard word to say, guys. 4 billion. That's Billy with a B. Per operation. I think that starts in the first week and a half or so of September. But hey, whenever they announced that, everything just started flying around. So what I thought I would do is pull up a chart over here. And let's go to my trading view because I saved just kind of a list of some charts earlier to get a decent idea of what happened. So anyway, buying back bonds, guys. Think of it like the old fish. If anybody has ever seen The Big Short, and there's a scene in there where I forgot the cook's name, but anyway, he's talking about having 2 or 3 day old halibut, 2 or 3 day old fish. It's kind of when they were talking about the tranches and the mortgage-backed securities and combining all the crappy stuff, basically. So anyway, when it comes to these bonds, well, they get kind of stale at times, stuff that's not selling. So what they did is they just basically issued a new round of bonds out and, basically bought back what they already produced. So it's kind of like turning that fish, that 2-3 day old halibut, into a fish stew and selling it. So that's about the easiest way that I could think of off the top of my head to explain it. But anyway, yeah, when that came out, we saw the TLT bonds start to skyrocket there. This is a 1 hour chart just to keep everything kind of simple. Well, as a result of bonds going up, what happens to yields? Okay, the 30-year yield, which just had hit that high level, dating back to the great financial recession that we had back in 07, 08. So that started to come down as a result of that. Just think of this as a pulley system between bond prices and bond yields. Okay, when bonds go up, yields go down. And when yields go down, this happens quite a bit as well. The dollar index will go down. Okay, less yields, less reason for foreign investors to have access to their dollars. A lot of times they'll just go ahead and get rid of it, put their money elsewhere. So dollars down, and then you had gold and silver, bottom left here, start skyrocketing. Well, what's the relationship of the dollar index to precious metals, especially gold and silver? Dollar down, gold up. Okay, gold does not like high yields because it's a asset where that you can't earn a yield on. Okay, non-yielding asset, what they call a non-yielding asset. So when yields drop, you see your gold and silver start pushing up pretty high. And then we had a little bit of reaction, not too much, from some of the indices. Now that was the main index, big spike up, big gap up after yesterday's gap down that we had, but it wasn't anything that was too crazy. So I just thought this might be a good picture just to give you guys. So as the bond market goes in general, so does everything else. Okay, that's kind of where things kind of start. The bonds, the bond prices, obviously the bond yields, which everybody pays attention to and clamors over because it has a very big bearing on what's typically going to happen for the dollar index, gold, silver, and everything else. So with that, I thought we would go back over here to the indices and dig a little deeper into those. And again, guys, as always, if you have any particular assets that you're looking at, here, let me refresh that. Then just poke them into the chat there. I should have access to the chat for X. Let me just double check on that. Yeah. And again, we did not advertise it on X just because I wasn't 100% certain I was going to get it to work. But it's clearly working, so we good. So we'll get that put on the calendar if you guys happen to be on X. This way it'll give you an outlet. I think we're going to also play around with Instagram Live as well. So that might be something that we start next week. We'll just work the kinks or whatever kinks may or may not happen on X first, and then we'll be over on Instagram. Just trying to get it out to more and more people, guys. You know, some of you like X better, some of you like Instagram better, especially the younger crowd out there. Some of you are the OGs like myself and just prefer to stick to YouTube, right? So that's totally fine. The whole point is to make it more accessible to more and more of you out there. So, okay. So let's go. I wanted to look at the indices over here real quick, and then we'll get into the FOMC minutes, which is what you were asking about in BVN here in just a second. Okay, so there's your S&P. Again, this is a 1-hour chart. You had an immediate push up on the indices, but they have pretty well since retested and kind of came back down to earth. So nothing really too sustained over there. There's your Russell. I know I don't pull up Russell very often, but there's your Russell 2000. Even the Japanese, the Nikkei kind of got a little bit of a spike as well. UK, Germany didn't really affect. So that's just a quick look at your indices there. Again, though, it's all about the dollar dropping. When we go over here, and you guys have remembered, I've been talking for a while about this daily demand, this yellow daily demand zone, as well as this former resistance that became support. It just so happened to be in that same area. And that's basically what was giving us the hang up after this big drop that we saw from Kevin Warsh's rate statement, rate release, and then the rate statement itself, the presser. So after we got that big drop, okay, and this is the end of July, so basically 3 weeks ago at this point, big drop, and then this is a lot of times what happens. We start bouncing into those demand zones or supply if it were going the opposite way, and it kind of stops it in its tracks. It's got nowhere to go because there's so many unfilled orders from, you know, not the Dixie per se, but just when it comes to Dixie-based assets or dollar-based assets, dollar yen, dollar CAD, euro dollar, not to mention you know, stock indexes as well. So anyway, yeah, that's basically what it took to kind of cool the dollar off, was to come out with the bond buyback program. And then also, just 30 minutes ago, the whole reason why we set this show late like this is because of the updated FOMC minutes that was just released a short bit ago. Came out about right out at 1 o'clock my time, so 39 minutes ago. Now, when it comes to the FOMC minutes, it's going to be a little bit more of a nothing burger, not anything close to what we saw this morning from the doubling of the bonds buyback. But let me see. Let me go back to my notes I wrote down over here. Okay, so for the FOMC minutes, I've got some notes of what was consistent with Kevin Warsh's remarks and separately what the minutes add. So just to give you a little bit of a duo approach to this. So the consistency, obviously the rates we know are at this point stayed at 3.75%. Retained the strong will deliver price stability language. Okay, that was consistent with the minutes, just like Kevin Warsh blabbered about a few weeks ago. Inflation remains elevated with upside risks. So we got, so really the biggest change to that is the fact that we had yet another cooler set of CPI and PPI readings earlier in the month, right? That's obviously something that we didn't have access to when Kevin Warsh spoke to us 3 weeks ago. But we have to keep that in mind when we're talking inflation, because that now makes 2 months in a row where we had the cooler CPI and PPI numbers, the core consumer price index, producer price index, and we've got PCE, which is the personal consumption expenditure reading coming out at the end of the month. Yeah, Praveen. Yeah, I'm sorry. I'm looking at your chat now. No news is good news. Give me 1 second, guys. Why is this redoing it? Okay. Yeah. Really, the hot potato or the wild card or the elephant in the room was, again, just the buybacks that was mentioned this morning with the bonds. When it comes to the FOMC minutes, not really anything too crazy. We'll dig into some of these dollar-based assets here in a second on the charts. Just to go dig a little deeper over the past, we'll put on a 5-minute chart and take a further look at FOMC minutes. Yeah, I just arrived. Yeah, the FOMC minutes just happened 41 minutes ago. That's literally where I just started getting into right now. So yeah, let me just go back to my notes here. So yeah, rate steady at 3.75%. Will deliver price stability. That language was in the minutes as well. Inflation remains elevated with upside risks. Again, we did have a CPI and a PPI, a cooler reading that came out since Kevin Warsh spoke. Labor market stable, growth solid, AI investment a key support. We've obviously had a lot of AI reporting of late for earnings, a little bit of sector rotation there a while back. But when they say labor market stable, it's stable, but you got to remember that we have had, if we go over here to the dollar heat map, we have got 4 out of 5 of the employment readings, which is going to be this bottom 5, that have missed the expectations of late. So remember the jobless claims number last week that we had, that was the first time in about 2-3 weeks, maybe 4, where we actually had higher jobless claims. Okay, so that flipped our box bearish. Prior to that, we had a JOLTS number that was a little bit lower than the forecast. We had the ADP number that missed. And then remember, we had that hideous, ugly, disgusting NFP or non-farm payroll reading back on the 7th, so 12 days ago. So 4 out of 5 of your labor market sets, labor data sets, have been missing expectations. But overall, still remain strong, right? This is obviously just the most recent reading, but that's what they're talking about when they say labor market stable. Middle East conflict flagged as a major uncertainty and inflation risk. Well, we already knew that. We talk about it here on the stream all the time. So again, just stuff that Kevin Warsh was already saying in the minutes. What the minutes add? Well, a little bit clearer view of the internal debate. 3 formal dissents wanted a 25-point hike immediately. So remember, we've had a little bit of a mixed federal board of late, where you've got half the group trying to go one way, the other half go the other. So that is one thing that they did clarify. You had a few people that were after that hike immediately, which I gotta be honest, I'm not quite understanding it, because we have had 2 months in a row of inflation cooling, right? That's part of the reason. So I don't know. It'll be interesting to see how the PCE treats them at the end of the month, which, if we already had a cooler CPI and PPI earlier this month, again, not always, but a lot of the times that kind of previews what the PCE is going to give us at the end of the month. So the September rate decision is coming up at September 19th, I think. So right at 1 month from today. Many participants said further tightening would likely be needed if inflation does not decline. Explicit concern that financial conditions may not yet be restrictive enough, and more detail on AI-related price pressures and the risk that a prolonged Middle East conflict could keep inflation sticky. So that's basically it, guys. That was the notes. You've still got the geopolitics in the Middle East, which honestly I haven't even thought about today because of everything else with the bonds. But President Trump said that he is not extending the 60-day ceasefire that just ended a couple days ago, 2-3 days ago. So that's going to create some more uncertainty. That could create some more inflation down the line. And one thing to remember when it comes to those inflation numbers is, yeah, we've had 2 months in a row of cooling data, but remember, we got to also keep in mind the big spike we saw from April to June, right? This is what they mean when they say sticky inflation, is the CPI, when it's above 2%, on average been hanging out around 2.93%. And then we did get a couple cooler readings. We didn't quite, on those two cooler readings in February and March, which remember represents January, February data, right before the war started. They got low at one point, but it didn't quite get as low as May of last year, where it got down to 2.3. So obviously when the war started, basically February 29th, okay, which would have been technically, well, not February 29th, I'm sorry, March 1st, since there's only 28 days this month, or this year in February. This 2.4 reading, remember, was February's data. So after 1 month of the war, we go from 2.4% all the way up to 3.3%, right? So we were feeling pretty good about ourselves because it had started to cool down. It was still sticky because we weren't at that 2% target rate. But again, when we got our March data, the first month of the war in April for the April reading, that's where we saw that big ugly spike, 0.9% to the upside. Well, a month later, we had 0.5% higher again. And then a month after that, we had another 0.4% higher. And that's where the ceasefire and everything started to come in, started cooling things down a little bit. So when they say, when they're showing concern for the inflation, well, it makes sense. Because if we don't have a 60-day ceasefire anymore, President Trump's already pretty well committed in front of the reporters to not renewing it. And he's talking about going and ending things. If they don't wave the white flag, then we very easily could start to see some more strikes coming out. That's not something I want to see happen or predict, in haste, but that's just kind of the reality, because we already know that President Trump's not a pushover. Love him or hate him, he's not a pushover. He'll come out swinging. And they're just not ready to make a deal. President Trump himself claims he's not in a hurry, right? Despite the midterms that are coming up here in a few months, a couple months. So that's just kind of where we're at. It's almost like a stalemate. It's kind of like North Korea, South Korea. They started their war, their civil war back in the 50s? The 50s. And nobody really pays attention or knows this, but North Korea and South Korea, they're still technically in a war, right? They're not actively fighting on the front lines like Russia, Ukraine are right now, or like Iran and US were earlier in a few months back. But they're still sitting there guarding the DM zone, the demilitarization zone. You got the North Korean soldiers pointing towards the inside of North Korea. You got the South Korean soldiers pointing and North Korea is doing that to keep people from escaping. South Korea, their soldiers are 5 feet away from them, looking towards North Korea to prevent people from coming in. So it's just kind of a weird situation over there. I'm not saying that this is anything like that, or it's going to take 70 years to figure out, but the point is it could turn into a stalemate, something similar to that. A lot of people are projecting that. I don't know that I'm going to project that. I don't think President Trump will have the interest for that or the time, right? Obviously, we don't have dictatorships like they have. So we're in and out of our presidents over here every 4 years or 8 years, depending on the secession. But anyway, the point is, it could be a little bit lengthier of a process. We just don't know. you get rhetoric out of both sides. Every time the U.S. says that they're doing this, this, and this, Iran pretty well rebuts it and says completely the opposite. So it's just kind of a sticky situation right now. So inflation very easily could stay elevated for longer, just like the board members were cussing and discussing about for what the minutes added into this lingo. So bottom line, minutes, they pretty well formalized the same resolute, data-dependent stance Kevin Warsh struck publicly. You guys hear the same rhetoric all the time. Data-dependent, not going to rush to any judgment. No soft target on inflation. And he said that. He said no soft inflation, meaning no soft target, meaning it's a hard target. He insists on getting the target inflation rate back up and running. So that would be 2% or lower. But not too low, because you have to have some type of inflation left so that businesses and such can continue to grow, right? Make the economy machine spin. So I don't know what that lower end is, maybe between 1% to 2%, kind of like Japan is right now. Guys, remember Japan, if we go look at their inflation over here, look where they're at. See, this is more of the sweet spot where Japan is right now, right? They got a similar target rate, 2%. And they finally got down there, and they've reached it the last 6 months. So congrats to Japan for actually getting down for 2026, to that sweet spot. That's what the U.S. is trying to do. That's what a lot of countries are trying to do, frankly, not just us. But that's what they're after. So that's what Kevin Warsh means when he says this is not a soft target. It's a hard target, meaning he is 100% after that target. Willing to tighten if needed. Well, we know that because we know that's what President Trump wants is 25, 50-point hike. President Trump wants a 1-point hike, or a 100-point hike, 100 basis point hike. But I don't think he's going to get anything close to that if they happen to tighten it more. So we'll see. While showing a clear hawkish minority, already wanted action in July, no major pivot or softening versus his earlier comments. So for that respect, it was, that's why I said at the outset, it's just a little bit of a nothing burger, but just kind of clarifies what some of the other Fed board members were talking about. So that's my piece on the minutes. That's my piece on the bonds. And yeah, pretty well already showed you kind of just some of your top line assets and kind of how that reacted. Again, bond prices up. The opposite of that is bond yields down. Dixie, the dollar, likes to follow yields generally wherever it goes. We already know gold and silver tend to do the opposite of what the Dixie likes, and it follows yields closely as well. Again, metals, non-yielding assets, so they don't give a shit about yields, right? They want to see, they prefer they just drop so that the price of gold and silver can continue to push up since the dollar is dropping, right? And then again, the indices, while they did pop higher based off of that, they did kind of retrace. So they're pretty well back to their starts. So yeah, it was all about the yields dropping, Dixie, gold, silver, and Bitcoin, by the way. If you guys have been paying attention to Bitcoin today, it saw quite a hell of a pop. So currently, I think Bitcoin and Ethereum are still at the top of the list. Look, Bitcoin up 5.6%. Ethereum up 9%. It's 8.95 or 98.99. Let's go take a look at what else we got over here. Okay, the indices, we already saw the dollar drop. Yeah, indices themselves pretty well similar. Hong Kong down 3%. Futures, yeah, again, you got gold futures down, or excuse me, up 2.9%. Silver futures up 3.1%. We go take a look at some of these charts. Oil, not really affected. Nat gas had a little bit of a push higher as well, but it's pretty much retraced its spike it saw. And when we're talking currency pairs, just dating back to yesterday's intraday switchover, I don't really think we have anything too crazy. Aussie Swiss down 1.2%. Pound Swiss is down 1.1%. Yeah, if we're just looking at percentages, okay, dollar Swiss. So dollar Swiss is one of the bigger declines today, 1.74%. That might not sound like a big percentage when we're looking at things like Bitcoin and Ethereum being 5, 7, 8, 9% higher. But for a currency pair, 1.75% move in one day is actually pretty substantial. And this is what we're talking about, $4 Swiss. Now, I like this because dollar Swiss is one of my bearish pairs. It's, in fact, I'm pretty sure that's the one that's the most bearish asset on my list. Let me just make sure. I just want to make sure I'm not missing any. Excuse me. Oh, that is something. Okay. No, I was just making sure everything was looking good on my end over here. Profile. Perfect. Well, yeah, and just to test out the chat piece of X, if anybody in X is there, yeah, let me know. Just let me know so I know my text works for my chat. But anyway, so yeah, going back to my top setups, just gonna punch a couple buttons over here real quick and see what we got. I just want to look at my top setups list. So pound yen at the top, pound dollar still up there, silver and gold still up there in a very bullish territory. Looking at a few other pairs, CAD yen, pound New Zealand. I can get my mouse to work over here. Yeah, dollar Swiss still the most bearish pair out there for me, guys. Dollar Swiss, dollar CAD's right behind it. The dollar index, it's very bearish. Okay, it's just looking pretty disgusting right now. We know that because of the data that we just looked at over here, right? Talking about the data, talking about all the red on the screen over here, and the fact that it's only got an 18% beat rate. But remember, the Bank of Japan, they're feeling the heat too. They're down there at only a 14% beat rate. And Canada dollar, like we showed yesterday, is still the number one currency of the 8 majors when we're just talking a straight beat rate. The economic calendar and what percentage of those high impact economic calendar events are they exceeding expectations on it. Canada is at the top because they did have that higher inflation reading a couple of days ago. Japanese yen index showing quite bearish. The Nikkei. So yeah, the yen and the Nikkei in Japan are feeling quite the heat. Oil has officially pushed into a little bit of a bearish territory for me, guys, as far as your fundamental sentiment combination there. And even that gas. And when it comes to Ethereum and Bitcoin, they're still just barely a little bit neutral. Now we're getting the spike today, obviously. But if anything, I got to tell you, they're a little more bearish than bullish. If we're just strictly isolating the economic calendar data and how it reacts to the U.S. data. So anyway, let's go take a look at the majors. Let's see what you guys got. Yeah, Bitcoin. Let's start with Bitcoin. So let's dig a little deeper into Bitcoin for you guys. So again, as always, I want to know where my moving averages are. I want to know if I'm hitting higher highs and higher lows. And the cool thing with Bitcoin, and you guys know I've kind of pissed and moaned about this for a while, but Bitcoin had been doing what forever? It's been going sideways, right? Just straight sideways. Well, guess what? We finally broke through some call walls on that bond buyback news this morning. There's a call wall right here, that green line going right through that supply zone, which is partly why it was kind of being pushed down a little bit. We see it had that call wall had pushed price down back here as well, pushed price down here, down here, down here. Even if we go a little further back, right? That's basically the that's basically been one of the main spots, kind of keeping price from going north, from going up for quite a while. Plus, there was a call wall a little higher where it bounced into twice and got rejected. And oh, by the way, there just so happened to be a supply zone going through that, right? So the supply, as far as I'm concerned, is old news at this point. But there still remains those options calls there that were stacking up quite nicely, and that's just one of those things where you got bullish bets just sitting there chilling and waiting for price to come up. Price comes up, tags them in, and then what happens? They sweep. This is your liquidity sweeps, guys. I don't think I pushed this or talked about this too much to you guys yesterday. I did on another stream I did. But is it a real surprise where every time you have bullish bets, the green lines right there, price comes up to it, peaks in, and then does an about face and rug pulls them? Again, just like this middle green line, rug pull here, rug pull here, rug pull, rug pull, rug pull, another rug pull, right? So the point is, yeah, seeing where your big stacks of calls and puts are in the options market is just yet another retail sentiment type of an indicator we can look at, just like the regular, cash market retail sentiment. Well, we finally pushed through all that noise. We pushed through this was this morning let's go back to the 1 hour chart here. Okay, we pushed through this daily and 4 hour supply. There's your 4 hour, there's your daily. So for Bitcoin, I got to be honest, if I were just looking at this just technically, just as a chart, just as a technical analyst only, well, if we come back down, just like what my projection arrow shows there, that's probably what I'd be after. Because we have what's called a flip zone that basically just got created right here. This was a former former resistance rather, turned support. A former supply zone turned demand zone. That's called a flip zone. Whenever you get price just chew through a supply like that and then retrace, and do it with strength, by the way, that's the key. Well, if you go back to this same period for all the assets, doesn't matter what it is, most of your currency pairs, gold, silver, Bitcoin, maybe not so much oil, but nat gas to a point, your stock indexes, no matter what country we're talking, we're not even talking about just U.S. Okay? Talking Japan, talking the German DAX, talking the FTSE 100 if you're in the UK, right? A lot of these, just the volume spread analysis, which you guys hear me talk about a lot, gave us a lot of big red candles. Can you sense the excitement in my voice, guys? Well, this is why. Effort matched result today in everything. So you give me some retracements back, and chances are these traders, these bankers, think about the bankers for a second. Okay, this news came out this morning. Maybe the West Coasters out there, the whales around the world, maybe they didn't quite get their orders in when they saw the bonds drop, the bonds headlines, the doubling of the buybacks. Well, price ran off without these guys. And this is going to be one of the rare times, guys, if you're a breakout trader, that you actually had some success. Because anytime you get to these support and resistance lines, okay, these supply and demand zones, in this case, same thing, because we can track those points back quite a bit to where they were relevant several times. Well, hey, breakout buyers had a heyday today. Okay, now I think that's the exception, not the rule. And I don't trade breakouts because I always look for discounts. And if I would have bought back here, okay, that candle hasn't existed yet, right? That candle has not existed yet. If I were to be buying right here, I'd be buying right in the teeth of overhead supply. We don't know that this is going to happen and keep going like this, right? We just don't know that. So all I'm saying is if we get a retracement back to that area, then think about the smart money here. If they put in a full position, God bless them. If they had an algorithm that did it, God bless them. If they didn't, if they were trading this manually, if they lucked out and got a little bit of a buy, a little bit of accumulation, well, congrats. But I guarantee you there's a lot of banks around the world, a lot of institutions that are looking at this thinking, dang, I didn't have time to accumulate my full position before it pushed up. So that's when we wait for the retracement. Now, it's a long ways to retrace after that fast spike on all this institutional activity. But point is, if you get the retracement, well, that gives them another reason to add to their orders, accumulate. And if you started your accumulation process here, well, the last thing you want, talking about the smart money, the last thing you want is price to go this way, right? Because then you're upside down, you're belly up in your position. So they're going to defend that. They're going to defend that area where this liquidity started just coming in hardcore. Okay, let's look at gold for a second because it's easier to see on gold. Yeah, and there you go. So that would have been 7 a.m. my time, so 8 a.m. New York City time. So 1 hour and a half before the cash market opens. 8 a.m. New York City time is when a lot of these crazy things are mentioned. Let's see how high it'll go. That's right. Gold retraced, Philip, back to 4,000. I don't think so. I think there's a lot of smart money that added their positions, and I'm obviously talking about this VSA candle, this 7 a.m., 8 a.m., 9 a.m., 10 a.m. area right here where we had all these buyers really, really hardcore stepping in. I don't know. I feel like they would want to defend this position, kind of like what I was just sharing with Bitcoin a second ago, because that's a lot of money. We already know it takes a lot of money to break structure. We already know it takes a lot of money to break overhead supply zones or underneath demand zones. So if there's a lot of money that went into the system, a lot of smart money, I think the last thing they want is for price to drop down to 4,000, because then they'll be belly up in their positions, right? There's your 4,000 level all the way down here. No, that's 4,200. I'm sorry. Yeah, 4,000 is all the way down here. So, you know, there'd be a lot of people taking losses up there. And in something like gold, yeah, I mean, it wouldn't shock me because we are still technically inside of this supply zone, this daily 4-hour supply zone over here. So I don't know. I don't think they want price to go that low. You know, the smart money, they're a pretty powerful bunch of people. So if they just spent all this money, right? If they just spent all this money going long, I think they want to defend this area. That's just my thoughts. Maybe they'll let it go a little deeper, see if they can't get a little bit of a turnaround, but they control the purse, right? Power of the purse. The Citibanks, the Wells Fargos, Morgan Stanleys of the world, East Street, BlackRock, right? All the hedge funds out there. I don't think they want price to go the other way. So that's just my thoughts. So I don't think gold's going to 4,000. Now, I could be dead wrong, right? Even if you get down towards that area, well, then you got this other zone to worry about. That's that one, that daily that I was talking about a while back that had the 2 4-hour demands inside of it. So that's a zone on top of a zone. If you start coming all the way back to this area, then I would think that would be the final support area, right? Let's just say they take a big ass loss up here and price does retrace. They start, throwing a whole bunch of bombs again, Iran, the U.S., Israel. If that were the case, yeah, I could see gold coming back. Because what did it do whenever we had war? Whenever we were in the thick of the war back in March, April, May, dollar kept pushing up. It kept benefiting from all the strikes. And what did we see from gold and silver most of the year? Just big, ugly declines, right? So I don't know. I'm not Nostradamus, but my guess is they would probably want to defend where we're currently at right now, right? So that's gold. Silver, we did get a spike as well, just like gold, but silver's kind of in a weird place. So if you guys remember, I talked about the overhead supply that we had bounced into really starting back on August 7th. So that would have been 12 days ago. And then when we bounced into the red rectangle there, that's where our 4-hour zone started. And that's literally where we started getting all those wicks on the daily. So wick in here, pushback, wick in, pushback. Another one over here, wicked up and pushed back. Now we're touching it a 4th time, but in the creation, or in this new low that we broke, we actually created another supply zone right here. And as you can see, we're just now bouncing into it. So we still haven't chewed through the original daily supply. And then we created a 4-hour supply that broke a structure out of that. So for me to be interested in buying silver, I would want to see just what the yellow projection line shows. Let's break this, not only this supply, but the remnants of the daily supply from back when, way back when, June 22nd. And then same thing, I would need a discount, right? Price is up here, it's broken, it's closed. But breakout traders will be buying up here. We know that because that's just your typical retail behavior. FOMO trading, prices going up, it must be going to the moon, let's buy. Only for the smart money to do what? Take their buy orders and fuel their sell orders to push price down. Completely flip the script on the retail crowd. Now the retail crowd sees this move and they start selling. Okay, and then what happens? The banks start saying, okay, you're selling, so I'm going to buy into your selling. And again, they like to do that in these zones because now you've got retail traders selling to fuel their buy orders. And then you've also got the liquidity from the demand zones with that unfilled order potential to push price up. It's a double whammy, guys. This is the game that's played in front of us. The game of liquidity. So that's the play I would be looking on for silver. But if I had my choice between silver or gold, I'd be going gold. So gold, I want to see the same thing. I want to see the break of the supply. But rather than this move, okay, I'm talking that zone right here. So very similar demand zone setups for gold. And well, silver's I guess a little different, but gold is a little higher. And I just like this one. Give a retrace back to that place. And we may not get there, guys. I was telling my live stream crew this morning on another project I do. With all the supply and demand zones I draw up for potential places where I may buy or sell something, I may only use 5 or 10% of them, right? The rest are just, price goes away. Price keeps going up another peg, another rung, another several levels. And then that zone just kind of gets lost in the shuffle. And maybe 3, 4, 5 years in the future, maybe prices retrace back down. Maybe that demand zone or supply zone comes back into a little bit of importance. But when I draw these zones up, I always draw them up with the expectation that it's going to turn around and give me a discount right away. Well, if price moves up, like it does here, then maybe, maybe a new zone creates itself somewhere up in this area, right? And then I could start looking at that zone, right? So I do put a lot of colors up here, a lot of funky colors. I try not to put too many because I don't want to overwhelm or, make it look messy or anything. But yeah, that's what I'd be looking at. So gold for me is 43.74, but it'll be made 100% complete if we do get this break, which we're not too far away from, by the way. It only needs to go up another $15 on a $4,500 instrument. That's not much at all. So if we get a close anywhere up here, hey, give me that retracement to the breakaway point, the origin of that strong move up. I'm in like Flint. Now that's not financial advice as always, but I'm just showing you what I'd be interested in doing. And then for silver, yeah, well, if we break and close above all this, then I may reevaluate it a little deeper. Because silver didn't quite get the same move that gold did, right? Yeah, so definitely gold would be my favorite. I'll just leave it at that, not to overcomplicate it. For you nat gas traders out there, we did bounce into that daily supply. We're starting to get a little bit of rejection from there. You got your 4-hour confluence point, a little bit higher though. High supply, still the hottest part of the summer, especially for us here in the U.S., here in Kansas, where we've just had nothing but stifling heat. So we don't need no damn nat gas around here, not for another few months. The oil market, we're still chewing through that overhead supply. That's the one with the gap that we had, the down gap we had at the beginning of August after we had the July close up here. So just imagine that, a big red candle. And that's basically where we're fighting now. In fact, I might have to start thinking about this one for possible shorts now. Yeah, I don't know. I mean, yes, it is a daily 4-hour. Let me go look at this again. I just wasn't too thrilled with the daily supply. It just doesn't look very nice. I don't know. I got some thinking to be doing on oil because, again, we just finally have a little bit more data to go along with the possible oil shorts over here. And it's starting to look a little more appealing than it did a couple days ago when we started jumping in. So I don't know. I'll do some debating on this one. Might be into a short on this and then buy to cover ahead of this daily demand down here. So again, guys, take that with a grain of salt. That's just what I'm thinking about doing. And for Brent crude, a little higher up. Still looking at these overhead zones up above. I need to clean this one up a bit too. It's been a while since I've looked at Brent. See, it's the liquidity is the problem. If I go back to oil or crude, Brent, WTI, yeah, that's partly why I'm a little skeptic on this. Because when we did get that gap down, yeah, we had a pretty good push, but we didn't break this structure immediately, did we? We rebased, pushed back up, and then dropped. So that supply did not break that low on the first go around, the first decline. That's part of my hangup. This one up here did, okay, it gapped down and just kept going. We didn't have any basing structures like this right here until after we broke this set of structures over here, right? So I think that one looks a little better. Plus, it's offering up a better premium. Now, that's not options premium, okay? So I don't want to confuse you with that. Just premium meaning higher prices. More expensive price for me to sell at. Why would I want to sell my used car here for $10,000 when I can wait a little bit and sell it up here for $12,000 or $15,000, right? So that's why I think I would prefer this site up here, or that price point. Let me go double check over here with you guys. That's discipline. Yeah, takes a lot of discipline in this game, I'm telling you. And guys, listen, I was not good at this when I first started. I joke around. I was like a baby scorpion. I think I mentioned this to you guys yesterday. I used to buy and sell every single zone I could find. But after you get burned enough times from touching the stove, despite mama telling you 100 times, you eventually stop touching the stove, right? So, yeah. I am the worst critic on my own strategy. And all I'm doing is looking for a collection of candles before a strong move up. That's if you stop and think about it. Well, how could that be difficult? Well, it's not that it's difficult. It's just that I'm picky. I know I've showed you guys my list of items over here that I go through every single time, just to let's see. Let's go. That's my trade plan. Right. I know I kind of go over here a time or two. Right. I've got this many steps whenever for my zones, right? Got to be strong. Where's that supplier demand zone in relation to the curve? In other words, am I buying a discount? Or am I buying too damn expensive? If I'm buying at a premium, how fast did price leave the zone? It's got to leave fast. How much time did price spend in the zone? Well, it's got to be 4 candles or less, guys. If it's 5, 6, 7 candles, it's too much time spent. Am I buying that zone under fair market value, under the black holes? You guys hear me joke about that? Under the equilibrium points, right? The fair market value. Am I buying in a black hole? Nope, I'm not taking it. Am I buying above a black hole or above that equilibrium point? Nope, I don't want to take it. Buy if the trend is up. Okay, am I in a downtrend? And am I going to buy in a demand zone? Nope, because that's short in a supply zone only. For me, I want to know if I'm starting to catch the meat of the move or if I'm trying to catch falling knives or stop rocket ships. So that's where I look at RSI. Has that zone been hit before? It has? Okay, great. I'm not going to touch it. What happens when price enters the zone? Is it giving me a reversal candle? Is it giving me a bullish engulfing candle? Is it giving me a hammer candle with a big strong wick underneath? No, it's not. Okay, I'm probably not going to touch it. What about my volume? What about my VSA, my volume spread analysis? As price is touching, am I seeing the VSA liquidity, the smart money, the institutional tick volume? Am I starting to see that come into the market? I'm not. Okay, nope, I'm not going to touch the zone. So you can see, and I know that sounds ridiculous, but yeah, that's what keeps me safe, right? That's that's discipline. Yeah, you're right, Praveen. But that's not something, this is not something that happens overnight. Guys, that's about 12 items that took me about 12 years to really get good at. So congratulations, Tiger. You got it good at one of these items per year, right? Now, I say that jokingly. I created this, I wrote this down a few years ago just to kind of put all my thoughts together. So I've been getting, I'm to the point now to where it's all, it comes from memory. But yeah, it took me a few years to kind of come up with my rules for myself. Not to mention the other notes over here. So anyway, sorry to bore you with that, but I did want to acknowledge what you meant, what you said there when you were talking about discipline. It's tough, man. It takes a while. There's people that have gotten there much faster than me, and God bless them. There's people that take 20, 30 years and they never figure it out. So, don't be that person. If it takes you a few months to get profitable, great. You're a unicorn. If it takes you 5, 6 years to get profitable, hey, I would say that's probably about average. Right? But the point is, everybody's different, so don't ever get discouraged if you're not profitable or you don't have an ironed out, trade plan yet. On that note, I did want to bring this up again. I know I did this the last couple mornings, guys. I did finish my trifecta trio system. So if you'd like to see my trade plan like this in action, this will show you how it's done. It's only about 5-minute videos on average. There's 10 of them. It'll take you an hour to watch it all. That's if I did my math right. What's 5 times 5 minutes? 5, 10, 15, 20, 25. Yeah, right at about an hour to watch the whole thing. So that'll show you how I put my trade plan in action. Again, the point is not to say this is the way to trade. It's just to show you the way I trade based off of my 12 and a half years of blood, sweat, tears, trial and error after learning the basics of risk management and supply and demand. Okay. How I put my algorithm together, my own personal algorithm. If you like a piece or two of it or a lot of it, great. Steal it. Make it your own. If you don't like it, you think something sucks or is stupid, that's great too. Not everything makes sense to everybody. And if you ever have any questions on it, again, feel free to let me know if you have any thoughts on any of the items from the videos. But I made that for you guys. It's something I've been wanting to do for a long time. But since starting with FXEmpire, I finally had the freedom and the time to be able to do this and put it together. And I have an awesome editor that helped put all this together as far as the final edits. So I would like to say that I would like to take credit for the video, but I absolutely cannot. We have a really good editor on the team that makes me look good for what it's worth, better than what I do. So we could thank Mr. B. We'll just leave him at Mr. B for that. All right, guys, I got like 8 minutes left. So is there any other assets or anything that I missed up here? Anything else you guys are looking at? If not, then I'm going to look at just a couple of the major pairs because they have completely shuffled out of whack. Let's start with some of the alerts I put on. Let's do this real quick, guys. So these are some of the alerts I put on. As you can see, I had some that were triggered whenever that bond decision came out this morning. But for New Zealand CAD, this is one that was triggered as well. I just deleted it and I added a second one. I had originally had my supply zone mapped out right here on this 2-hour chart. But when prices spiked real hardcore and things got really volatile and our volume started spiking on everything, I did not want to have any, I didn't want to get involved with this supply zone at all because while it did look okay, the volume wasn't the greatest and we didn't break the major structure. We broke this minor structure right here after this pullback. It looks like it shifted, okay, looking at this 2-hour chart. 1-hour chart especially, you got higher highs and higher lows if we were to go down, but then you started lower highs and lower lows. But then when that came in, this down move was not strong enough for me to want to take a chance on this lower quality zone. And also knowing that we had a zone a little higher in that same move, right? Now this rebased, especially if you go look at it on a 1-hour, you had a decline, you had a base. So this is a drop, base, drop. right? So that was the whole reason I even gave this one the time of day to begin with. But when this happened on this 1 hour chart, and in just over an hour, we were already at it, I was not wanting to participate because of the volatility. I didn't know if this was going to keep going up for another 2, 3, 4 bars, expanded range candles like what we just had. But as you can see, things have kind of balanced out. So now that price action is balanced out, that's going to make me show some interest in this 2 hour zone that's just a little higher. Now the zone looks prettier to me on a 2 hour, right? That's about as simple to see as any zone I've ever seen in my life right there. You have 2 basing candles. So you have a leg in, you have 2 basing candles, and you have a leg out. That's about as pretty as it gets, guys. It just looked better than the 4 hour, because on the 4 hour, all I had was the wicks. And I didn't, and you know, when you go from time frame to time frame, especially if you're following the rule of 4 like I do. Okay, if I find a zone on a 4 hour, what's 4 divided by 4? It's 1. So 1 hour is where I'd want to go refine my entry. I saw this on a 2 hour, so what's 2 hours divided by 4? Well, it's 30 minutes. So I'd want to go refine on a 30 minute. Okay? On a 30 minute, there you go. There's my little bit of wicks going on right here, a little bit of clearance, so a little bit of a gap. And that's the important thing to keep in mind is I'm interested in this zone because we finally based out.